single accounting standard can determine whether Indian business groups are about to get bigger or smaller. Hello and welcome to Mind the GAAP. On this episode, we discuss the impact of the new accounting standard on consolidation. In simple English, that means which entity is or is not part of the business group. To do that, I have with me today V.S. Parthasarathy, Group CFO and Group CIO at M&M, Sai Venkateshwaran, Partner and Head Accounting Advisory Services at KPMG, and Sumit Seth, Partner and IFRS Leader at Waterhouse. Gentlemen, to all three of you, a very warm welcome. Mr. Parthasarathy, I'm going to start by asking you first about the key difference in approach towards consolidation between Indian GAAP, which is the prevailing standard, and Indian accounting standards, which is the new standard.
Just to get a perspective, I mean, I'm going to in a very non-legalistic way.
Thank you very much.
So if you looked at the old Doha, which said जात न पूछे साधकी पूछ लीजिए ज्ञान पढ़े रहने दो म्यान को जांच करो तलवार.
That's a poetic way of describing the shift from rule-based to principle-based accounting, one that relies more on substance than form. Currently, owning more than half the voting rights or control over the board of directors amounts to control. But Indian Accounting Standard 110 defines control as power over an investee and exposure or rights to variable returns from involvement with the investee, as well as the ability to use that power over the investee to affect returns.
This is a sort of very subjective control test.
Yes.
It is, you have to take numerous factors into account to determine whether you have control or not.
Absolutely. So irrespective of what model you operate under, so whether it's in a legal entity structure, whether it is as an entity where you have ownership or you don't have ownership, whether it is a silo within an entity, so irrespective of what the model is, it's essentially looking at who is ultimately controlling that business and who's controlling the relevant activities, and the relevant activities are the ones that most significantly affect the returns. So it's looking at who has the power to control those relevant activities, who has the exposure or the rights to the returns from those activities, and who's the one who has got the power to influence those returns.
Now we will have to kind of examine every contract that we have to see what does it mean. Okay. Especially most of our business, in the subsidiary side have private equity participation. We encourage that because that's the nature of an empowered federation.
Right.
Okay. So now we'll have to see how this contract, it says whether it is I'm going away from the initial one, but it is integral, whether it is participative right or protective right. And this is going to be a very interesting exercise. But therefore I see a lot more implications of this on consolidation, the top line, the middle line and the bottom line.
Okay. Sumit, then shall we start by, let's say, identifying different control scenarios, and then looking at whether entities under those control scenarios need to get consolidated or not, and if yes or if no, what the implications are. The first one, in the case of plain simple control, where you have either more than 51% or you are the largest shareholder, I'm guessing that's easy to understand. That's as per the current situation as well, you consolidate, right?
Absolutely.
So let's get to the next one then. What is de facto control? How does this play out?
So I think that's a pretty new concept actually, at least for India. So de facto control will be when you have one dominant investor, and if you think about Indian promoter group companies, right? They may, for example, hold 40% or 45% equity interest, and the remaining investors are dispersed, having small shareholdings. Now, typically, this dominant investor has the practical ability, right, to make the decisions, right, to get the resolutions passed at the meetings and so forth. So really, that this investor is the one who probably has the de facto control, and therefore this investor would consolidate the entity. So like Indian GAAP would, you would need to have more than 50% voting interest. But now even if you have 40% or 45%, for example, and other investors are really dispersed with small shareholdings, then this investor would actually consolidate the other entity.
Okay. Any thoughts on de facto control?
So this actually becomes very judgmental because there are 2-3 judgments involved here. So first is, when is it that you determine that you have significant shareholding? So for instance, if you've increased your shareholding over a point or a period of time, so when is it that you've reached that threshold that you say that, okay, now I'm the most significant shareholder? The second is to determine at what threshold you say that the remaining shareholders are dispersed. And the third bit is to see do those remaining shareholders have they organized themselves in a manner to act together?
Give me an illustration.
So for instance, let's say you have 40% ownership,
Right,
and let's say the
assuming
remaining 60% is, let's say, spread between let's say 20 different shareholders, each owning
Right.
less than 5%. Now, would you say that those, because it is only 20 in number and they're relatively spread out, that you are probably the single most dominant shareholder? But on the other hand, if these 20 have an agreement amongst themselves that they will act together in concert, then potentially you don't have control.
That's a very rare situation, right, that comes up.
We have a situation where the majority, the listed company has, let's say, 40% ownership in another entity. There's another 20% which is held, let's say, by one of the promoter or promoter's family, and so on and so forth. The rest are essentially split between a bunch of financial and financial investors. So
But all who have an agreement amongst themselves to vote in a
Now-
particular way or to
Now
determine
there are
certain things?
complex arrangements that are there. So there are agreements where in some cases the promoter entity has got a put option to buy out some of these things, or these investors have a call option to let's say sell out to the promoter. Now the question is that promoter entity acting as an agent of this listed company, because they have these complex relationships within themselves?
So
and
you would
forth.
have to consolidate
You would
in that
potentially
case?
have to consolidate in that case, because although you are only at 40% and you are saying that the remaining 60% are sitting elsewhere, but in one situation you could reach a conclusion that the remaining 60 are acting together, and therefore you don't need to consolidate. But if you also go one more step and establish that those 60 are effectively de facto agents of this main entity, you would actually end up back consolidating the entire thing.
Implications of this, Mr. Parthasarathy?
Yeah, I think fairly simple. I mean, it's just saying that if you're very close to being in control, but you don't have 51, consolidate it. It's easy.
Okay.
The judgmental part comes here. Okay, if I have 45%, easy. What if I have 40? What if I have 35?
What if you have 35?
30? What do you have at 25?
Yes.
Where does we draw the line of, where does we say we have, and we may be running the company and everyone may be letting us run the company because they know that we are doing a good job, let's say. It's a theoretical situation, okay, but you only work 25. But so that's where the judgmental part comes in, and in a sense are not like pack amongst the others, but you don't know who can acquire what share. You have no interest in acquiring and going to 51, but somebody may at some point have. So we don't know how to draw it. So it's easy when it is closer to 50.
I get that.
It's more difficult.
What
and
are
more
the
subjective.
implications? Because you may have created this entity and you may have capped your shareholding at sub 50% because you wanted it to be an off-balance sheet entity, so to speak. Now suddenly you discover that you can't change what the current situation is, and you're going to have to consolidate it, within the group.
I don't see any problem of, what's the problem in consolidating?
Let's say this group where you've maintained a minority ownership is probably a loss-making entity. It's probably got a significant amount of debt which you don't want to bring onto your balance sheet, etc. So those are the things which will now come onto your financial statement. So your debt equity ratio could look very different. Your earnings your EPS could look very different.
Earlier, I had structured one company to be 50% plus one owned by somebody and 50 minus one owned by somebody, but the other person who are lower had a board control. Both could consolidate. It was possible under the regime, so it was a structuring which was there. But the new rule generally says 1% consolidate, please.
Earlier it was easy to say that, okay, the Indian entity has got 51% control, so therefore consolidate. The other entity probably looks at it from an IFRS framework and says that I probably have a lot of the other operating control, so therefore I will consolidate. So both got the answer that they wanted, but today I think they would end up with a very different situation. So it could possibly be a joint control, so it goes under.
So this is where the problem is. This is the only place where I have some concerns. So therefore it will be a JV.
Yes.
So therefore neither can consolidate the revenue, so you can only do equity consolidation. This is where it is a little bit, you're saying you're joint control. Earlier proportionate seemed to be a much more logical way. Now you're saying no, nobody will consolidate. That entity in a sense is not, that revenue doesn't go to any parent.
Up next, we examine various control scenarios that trigger consolidation and accounting for ownership changes as well as joint ventures.
we've discussed de facto control and some of the sort of illustrations under that. Participative versus protective rights. Mr. Parthasarathy brought that up. It happens oftentimes. You have a private equity investor or some such investor, financial investor of sorts, who you've granted rights to. Now they get the right to consolidate. You lose the right to consolidate.
Actually, not like that. So what happened is, let's say, for example, you have an investor and it controls and it owns 70% equity interest, right? And the other investor, is 30%.
Classical insurance industry scenario,
absolutely.
right?
So you would expect this investor owning 70% to consolidate.
Right.
But in these arrangements, the other investors get substantive rights, right?
Correct.
Rights around, operating budgets, capital budgets, key decisions,
Right.
hiring senior management, right? So in that sense, you've kind of given away some important rights to the other investors. So in effect, you don't have, as what you call unilateral control, right? And therefore, this 70% investor will not be able to consolidate, and therefore they'll have to do equity method accounting. So I think this is one area where when companies are entering into financing arrangements, shareholder agreements, they should look at it. What rights are they really giving away to other investors?
What happens in a situation like this where you had the majority stake, you had maybe 70-75%,
Yeah.
you've granted certain, and the line on rights is also a fine one, right?
Yeah.
We've seen that debate play out with SEBI, etc.
Yeah.
Participative rights, maybe bordering on participative and not fully participative. What do you do in a situation like this, because you can no longer consolidate?
Yeah. So there is first is it's a practical problem, in the sense actually you are a joint venture in a sense. You have an economic right which is higher, either provided by such statute, because our things say that you can have only 51, 49, 74, whatever FDI. Yeah. The other one is also you want to bring certain amount of, saying in India I want to be majority, if it is elsewhere, this is also commercial arrangement. So it's a problem. But there is one way I think practically this can be resolved. What you put is a deadlock mechanism. What you say, in case we are not able to come to an agreement on this, then in the worst case I'll buy you out. Okay. In which case the 70% guy who says that, listen, as if you finally disagree with me and I can't operate, and therefore it's a deadlock, I'll buy your shares out at that point of time. If you provide that mechanism, then I think, then I believe you can consolidate. Okay. This is easier in PE. Because then what you are telling him is, you are a financial investor, you don't agree. In a joint venture, how easy is it to get this agreement done? And if you even said this is only for the purpose of consolidation, then we are again going substance over form. So this is a tricky, but there is one possible. I can think more over a period.
But that does mean a renegotiation.
Like I told you, that we will have to examine contracts under the new regime anyway, because sometimes in PE, what he said at participative right, the PE may see it as a protective right, but you are seeing the legal system says it's a participative right. So we'll have to think about how to. All these contracts will have to be.
Let's move on to potential voting rights. Now, what does potential voting rights mean?
So effectively, one is your current ownership rights and one is what you could have in future. So by virtue of, let's say, call options or convertible instruments and so on and so forth. So which, if they are, let's say, exercisable at a point in time, or when the decisions relating to the relevant activities need to be taken, I think those are then considered in the overall control evaluation. So that's.
So if you had potential voting rights that could take, let's say, your total amount of voting rights to above 50%, you would have to consolidate. Is that how I understand? Is it as simple as that?
No, I think
so first of all, you got to look at whether voting rights is the most relevant factor or the dominant factor to determine if how the entity is controlled. And if so, you're, let's say, at 40 today, but by exercise of your potential voting rights, let's say you could get to 55% at the time when the decisions relating to the relevant activities need to be taken, then you potentially get to an answer that you do consolidate.
I'll add to Sai, actually, the other important point is whether these options or call options, warrants, are they in the money or not, right? So if they're really deep out of the money, I think you don't have substantive potential voting rights. But if they're in the money, I think then it's, as Sai mentioned, they are something which you would consider in evaluating as to whether you have control. Because if it's in the money, it's likely that the investor will exercise that and therefore be able to get more than 50% voting interest.
Okay, I'm going to club the 2 points we've discussed, Mr. Parthasarathy, and put this question to you. What if you have more than 1 or 2 investors with whom you have these rights arrangements, as well as with whom you have these potential voting rights arrangement.
If you given participative rights to one or more,
Huh.
the same law applies that it's
Yeah.
equal. It's not consolidatable, and equity is the only method you can
Right.
consolidate.
I would
It's a
add to
one-line
that.
consolidation as against a full consolidation by any of the entities.
And I would add to that, I would also see other contractual arrangements, right? I mean, who has the rights from the decisions, correct? Who's able to appoint the board of directors? Again, the senior management, right? Decisions around the key activities, which we spoke in the beginning, about raising capital and so forth. So I'll look at the other arrangements.
We have this unique situation when you come to say a real estate kind of business, that everything is an SPV.
Yeah.
And everything, there is always a co-investor along with it who brings either the land or something, and they will always have some say in the matter.
Right.
And they want to, and why not? When commercially it is absolutely legitimate, right? So then, in this new situation, will nobody consolidate that? That's the unique situation this brings about. and
In
one
fact,
has
I
to
think in
become-
the power and infrastructure as well, we've kind of dealt with similar situation. Whether LISCO is there, LISCO probably doesn't have much of operations. All of the operations are done through SPVs, and in almost every one of them they have got private equity or other investors, and where you have ended up sharing some of these participative rights. So it came to a point where you said that you're actually not going to consolidate any of them. You'll only have no revenues, no expenses. You'll only have your equity pickup, which is your share of profits or
which is
losses.
not such a bad deal.
Yeah.
Like that
But
ratio will be
it is an optically your revenue will go down.
Yeah,
Exactly.
and I think you're right, when I think panelists look at it, when regulators look at it. So I was dealing with a situation where one such company was looking at an overseas listing. The regulator actually said, you don't control any of your businesses, so I don't think you're
Not
fit
just
to
that.
actually
Let me give you
get
another
listed.
instance. In the cases of bidding,
Yeah.
when you're bidding for public tenders, there are cut-offs that are linked to your revenue, etc.
Absolutely.
Now
Revenue.
suddenly you discover that your revenue, looks a little diminished because
Yeah,
of all
yeah,
of this, and you don't qualify for
That's
the
true.
tender to begin with, so
Yeah,
you cannot
yeah,
even
yeah,
bid.
yeah,
Something those circumstances will also come out.
And only one silver lining, you could still disclose some of that in segment reporting, right?
Final one, which is contractual arrangements. Sumit, can you walk us through what kinds of contractual arrangements will impact what you can or cannot consolidate?
Right. So one example could be, in the again auto companies, right? Auto sector. So you have manufacturers and you have ancillary component suppliers. Now typically you have a supply arrangement with these component suppliers, and also the auto company maybe funding these other entities. So based on the contractual arrangement, and depending on how these agreements are worded, right? You could probably get to a situation where the auto company may need to consolidate the component supplier. So I think that's one situation where, because of a supply arrangement or a service arrangement, right, you could get to consolidation.
Parthasarathy?
I don't think there are many such agreements, but if they were, I think the point is really valid.
You would
here.
say that within the industry, and it's fairly common to have these contractual arrangements, and therefore we will see many automobile companies
I think-
considering having to consolidate.
Yeah,
them.
I think he's saying equity involvement and arrangement.
So
Yeah.
loan funding, right?
So-
So
But we've seen that.
Yeah.
I
Yeah.
think,
We
I mean,
do.
look, in an effort to develop the ancillary
Absolutely.
business, we've
We do.
seen large
Yeah.
auto companies do this, right?
And therefore those companies will have to examine their contracts very carefully. Where, for example, most of the time what we don't do is to give them equity, but help them in all manners, like, if it is against they are giving lots of supplies to us. If we can support them by saying, hey, here is I can give you this much of debtors which I have, creditors which I have, and therefore, give it
Advance
faster money
funding of some
fund,
sort.
some
Advance
sort.
funding. So would an
Arrangement.
advance funding arrangement
Absolutely.
qualify as a loan?
Advance funding, guarantees given, right? I mean,
So
things
if
like
you
these.
had all of these,
Yes,
then you
and
would have to consolidate.
You have to consider for consolidation.
Consider to
Yes,
consolidate.
yes. I don't think it's a straightforward answer.
So
but
what
you've got to look at it, right?
what would negate the need to consolidate?
So really, again, it comes down to the activities of these components manufacturer, right? In terms of how the purchasing is done, how the manufacturing is done, who's deciding what is to be manufactured. So who's making decisions on those activities, right?
But suppose
If
it's a
if it is-
supplier linked to one company, and we've
Right.
often seen that happen, right?
Correct.
The ancillary business
Right.
supplies, let's say 90% of its sales goes to
Correct.
that one auto company or whatever.
Correct.
You use an equivalent in any other
Right.
industry.
Right.
then you would have to consolidate.
Yes.
It's not just in the autocom business. So in most other businesses where you have contract manufacturers, where the manufacturer is like only operating for you, so you would actually end up with a similar kind of an evaluation. Or for instance, he is, let's say, using your trademarks, your brands or something like that, or relying on your technology, etc. So I think those are relationships that you look at.
So for pharma companies is one more example, right? Where you have total manufacturing arrangements.
Or for instance, you're running R&D operations, for instance, which is in a separate unit, but ultimately the benefits of that R&D are going to accrue to you.
So does that cover, I think, at least some of the main scenarios that we wanted to look at and the implications of what those scenarios really are? A couple of extra points that I wanted to come in. Sumit, accounting for a change in ownership of an entity without loss of control.
So this is a very big change actually from current Indian GAAP. So under Ind-AS, once you have control, let's say you have 55% voting interest, and now you acquire additional 20% interest, right? Now this acquisition, which is typically a step-up acquisition, under current Indian GAAP, you would have recorded additional goodwill, for example. But under now Ind-AS, this would be an equity transaction. So you would just adjust that against your equity. So your equity will go down actually, be reduced to that effect. Okay. So as compared to standalone accounts, you will probably show a higher net worth, but in the consolidated accounts, it will be a lower net worth because of this one transaction.
If I have 65% shareholder and I told 10% from that company to go to 55, earlier I could have recorded the 10% as profit in my P&L, right?
Yeah, again.
Now you can't.
Now
you can't.
Yeah.
On the other hand, if it went down from 55 to 45,
right,
I can still take it to P&L.
Yes.
Yeah. So it's common in that sense. It's only within the category.
Correct.
There is no P&L impact.
Yes.
Amongst categories there is P&L impact.
So it's like a transaction between equity holders and their capacity as owners, so and therefore it just moves from different classes of equity, so from non-controlling interest into controlling interest and vice versa. So
if it is from subsidiary to associate, you will record it as profit. If it's associate to non-associate, you can record it as profit. But within the category of associate to associate or subsidiary to subsidiary,
you would have to record it as equity.
Even the retained interest, right? So for example, if you move from 60% to 40%, you recognize the gain for the 20%, but you also revalue to fair value the existing 40%, and that's again a big change, right?
So it's no more at cost, so you will probably end up with a significant.
So you'll have an unrealized gain actually coming in, in the consolidated accounts. So that's a big change again.
We discussed joint ventures when we were discussing control and de facto control, and even the accounting for joint ventures now changes. It is now a non-proportionate consolidation of joint ventures, is what I understand, right? Earlier they would contribute to your top line.
Yeah.
Now they will no longer contribute to your top line.
You could do line by line consolidation in a sense, if it was a joint venture till now. In Ind-AS, in the current accounting, in Ind-AS you will not be able to do that. So basically it's be single line consolidation.
So this will come as in above the line, below the line. How will this sort of appear?
So it will come somewhere between EBITDA and net income. So it's in that sense above the line.
So will it not come as minority interest in the line? No, it will come above.
It will be before taxes. Maybe a line just before taxes. Yes.
Okay, fine. Okay, I think we've sort of broadly covered everything with the exception of taxes.
So I think simply put, the reported tax expense will increase going forward.
Why?
Right. One reason is especially because of dividends, right? So when you have subsidiaries which are distributing dividends to the holding company, you have a dividend distribution tax. Presently, in the consolidated accounts, this dividend distribution tax is adjusted against equity, right? But going forward, it will be a tax expense in the income statement, right? So that's one thing. Also, you have to evaluate whether deferred tax liability needs to be recorded for the undistributed earnings, right? And that could again increase potentially the liabilities. And if you don't recognize it, then you go to disclose it. So I think this is one area potentially which would be a big impact, right, from a tax perspective, and of course net income which is reported going forward.
The other element which could again impact taxation is on your unrealized gains and losses on intercompany transactions. So there's currently the tax element does not always get eliminated, which will now also get adjusted. So
it's only your tax amount that will look larger.
Yes.
You won't actually be paying more tax.
No, that will be still determined based on actual dividend payouts by the subsidiaries.
So it's only an optic in that sense.
But liabilities will go up, right? So deferred tax liabilities could get recorded, for undistributed earnings.
Yeah. So again, judgment involved there to say that if you say that your the undistributed earnings are in a way permanently reinvested or expect to be reinvested, and you have no intention of repatriating it to the parent, then you potentially don't create a liability out there. But if the intent is to repatriate that to the parent then and suffer a tax consequence of that, then you create a deferred tax liability.
But Menaka, the point is EPS will go down, right? So, analysts, when they look at it, right, that's one area.
There are going to be very substantive changes from a point of view. Revenue goes
But you
down.
won't be, you'll be doing like to like, right? So
Yeah.
next year onwards, you will show
So you
comparables
just-
for this
yeah.
year, and in that already you will show a lower
Right.
EPS.
Right.
So actually somebody understands that, look, this is an accounting change.
Yeah.
Though I get it, optically this is going to be a big change for all of us in that
Just
sense.
say that you are accustomed to saying 14% EBITDA margin is a very good industry EBITDA margin. This is set over years.
Yeah.
Now the revenue changes, the EBITDA changes, and that it becomes 12% or 11%. While it will sink in over a period of time, the initial one
Reaction
mode
will
of
be as
reaction
if,
will be,
oh, margins
my God.
give
And
in.
so if you have two identical businesses that are being run, let's say in the same industry, one, let's say if it has subsidiaries where it's got PE investors and therefore participative rights, you don't consolidate, you only do JV accounting, you're actually the ratios get significantly impacted as compared to the other entity.
other ones.
Although the business and substance is
So it's a
identical.
big reset for all of us in that sense to be able to understand what has changed. In the previous show, Mr. Shankar Raman of L&T was saying that eventually for a while, as the stakeholder community adjusts, they'll all go back to looking at cash flow statements. And they say that the only way to determine the health of this company is through that, because everything else has changed and I'm confused, right?
So you heard this often enough statement, what is an illusion and what is the reality. It will become more the reality, a cash flow.
Okay, final question, one to each one of you. Let me start by asking you, Mr. Parthasarathy, how would you describe the impact on the Mahindra and Mahindra Group based on where you are today?
Just to give a perspective, there are M&M itself and couple of 100% subsidiaries won't shift any, no right going to shift that. So that amounts for the biggest part of chunk of our revenues.
Okay.
So it's not going to substantially change our top line or our middle line from that point of view. But it does call for examination of the way we do contracts, everything, and fine tuning. See, it's not that, if 100 crores become 10 crores is a big impact. So, then you need to worry. But 100 crores becoming 98 crores also, you have to go through the entire process of doing it.
Right.
Therefore, it's going to be a very hard set task to get from here to that pristine and still have the same level of confidence of both internal and external stakeholders in the figure. That, to my mind, is the challenge.
We discussed industry side that would get impacted. You'll give us illustrations on real estate, on power. I know one of your reports said investment funds, oil and gas, exploration, mining companies. Which sectors are likely to get impacted the most, and most positively, most negatively?
I think the ones where it will probably increase, it's difficult to gauge because that could...
And the ones where it will decrease?
Where it will decrease are probably the ones which use a number of SPVs, so power, infrastructure, real estate, pharma to some extent. I think these are all entities where you could see some of this change happening.
So it would be fair to end this by sort of generalizing, and I run a risk there, sort of generalizing that we will see groups get smaller or we will see groups get bigger.
So I think assets and liabilities
And
will
hence
increase.
and so
but
you'll see
net
the
worth
size of the group increase.
Exactly, but net worth could decline actually.
All right, on that note, I'm going to wrap it up here on consolidation. Next week, Mind the Gap will return with revenue recognition.